why don't we go ahead and get started? Welcome everyone to an official Elm webinar. Sort of one of our first. We're super excited about this. As a quick intro, my name's Jerry Bell. I'm one of the partners here at Elm. A little bit about how this will work. We're going to spend a few minutes talking about Elm, talking about the team. Obviously, spending a lot of time on how we invest, sort of answering a lot of the questions that we get, sort of the regular one-on-one conversations that we have with a lot of our friends and clients. You'll hear from Victor, James, and Mike, who some of the folks on this call may have met. If not, good opportunity to sort of get to know them a little bit. As questions come up, feel free to drop them in the Q&A. And then once we get to the end of the sort of prepared slides, we'll spend as much time on the Q&A as we have. After the call, we'll send out everything that we go over, including some additional information. So, if you need to step away or if we move past the slide before you've had a chance to sort of capture everything, don't worry about that. We'll send everything immediately following this. So without further ado, I will throw it over to Victor in snowy Wyoming to talk a little bit about his story and a little bit about why he started Elm.
Thanks, Jerry. Well, hi, everybody, and welcome. So I'm Victor Haghani, and I'm going to kick things off by telling you a little bit about why I founded Elm back in 2011. In the early 2000s, after a pretty eventful 20-year career on Wall Street, from managing director at Salomon Brothers in New York in the Liar's Poker days to being a partner at the hedge fund LTCM in London, I had a big aha moment. Despite all my formal education in finance and years working with really brilliant minds on Wall Street, academics and practitioners, I realized I had never spent much time thinking about how to manage my own family's savings. But, it was 2001 or so, and I was just about 40 years old, and I realized I really needed to do a better job and put some focus on it. I'm sure that some of you on this call have experienced the same thing that I did, which is when I looked around at the available wealth management solutions that were on offer, I was surprised that I couldn't find any that were both sophisticated and cost efficient, which is what I was really looking for. So I decided to take what I had learned through both my academic background and the School of Hard Knocks, of which I had had many, and to come up with my own approach. What I settled on was an approach that is rules-based, responsive to changing markets, tax efficient, and extremely low cost. And I knew that index funds and index ETFs would be the building blocks of my portfolio. So Elm's first client was my family, and then about a dozen friends and former colleagues joined the Elm Investor Group shortly after. And today we help over 400 families manage and grow nearly $2 billion of their wealth. So that's where we are today in 2024. We call our approach dynamic index investing. We actually have the trademark for that because, as it turns out, we're not aware of anybody else that does it. And it's an approach that adjusts the equity exposure in your portfolio based on changing expected returns and risk levels while maintaining the core benefits of indexing: low fees, tax efficiency, and lots of diversification. With our approach, investors are left with a liquid portfolio that can be comfortably held for long periods of time, and that's efficiently scaling with changing return and risk environments. So in the time since our launch in 2011, as I said, nobody else has picked up this approach to investing. And look, that's why I founded Elm in the first place, and that's why I have virtually all of my family's savings managed by Elm today. In a few minutes, you'll hear from Elm's CEO and my partner, James White. James also has close to all of his net worth managed by Elm as well. In fact, he was a client at first. And, talk about a really big endorsement. He liked what we were doing so much that he decided to invest not just his money in Elm, but also his time and energy by becoming our CEO. He leads a small but mighty team that is devoted to working with clients and supporting our growing investor base and devoting whatever leftover time we have to the research that we're regularly publishing on our blog, and which may have been the reason that you came to us. So let me go into a little bit more detail on our dynamic index investing approach. As I said, the bottom line of our approach is to give you the best possible chance of harvesting the returns available in global markets. I knew that to achieve this, that Elm needed to be disciplined, highly diversified, tax efficient, and cost conscious in every dimension. And I knew that both for psychological and performance reasons, that plain passive static index investing wasn't the complete answer. That's where our idea of dynamic index investing was born. Our system is rules-based. It's designed to be responsive to evolving market conditions, and at the same time, taking as much of the human behavioral element out of investing as possible. Our goal is to help you comfortably hold a higher average allocation to the stock market than you would accept if you had to choose an allocation today and stick with it for the rest of your life. We dynamically adapt your portfolio to the current market environment. I know I keep saying that. It's just the core of what we do. So let's go to the next slide where you'll see that the basic idea is that when the expected excess returns or expected return of the stock market is high, we're going to increase your stock market exposure. And when I talk about expected return here, I mean the expected return of stocks relative to a safe asset. And when expected returns are low, naturally, we're going to reduce your allocation to stocks. But managing your portfolio to reflect changing expected returns is only half the job. Managing the risk side is equally, if not more, important. So we also will increase your exposure to stocks when markets are peaceful and calm, and will decrease your exposure to stocks when stock market risk is high, like it was at the start of the COVID crisis in early 2020. To us, this makes a lot more sense than always having the same portfolio, regardless of what's going on in the market. So I'll stop here, and James will go into even more detail on this. And of course, we'll come back to all of this in the Q&A at the end. Thank you.
Great. Thanks, Victor. So there are three dials that our investors can use to customize the portfolios we manage for them. The first two set what we call the baseline. And to understand the baseline, we envision what we call the baseline environment, which is a hypothetical environment in which all global equity markets have a 4% risk premium and neutral momentum, neutral risk level. And it's not that we think this is an average environment or that the world will, on average, be in this environment. This is just a hypothetical environment we use as a calibration point to understand in a given environment how much risk should you be taking, or what is your level of risk aversion. And so the first two dials pertain to the baseline. The first asks the question, given 4% risk premia, how much of your portfolio should be in diversified equities versus in low risk assets? And then the second asks the question, also in this environment in which all markets have a 4% risk premium, what mix of US versus non-US equities would you like? And the default is our adjusted global market cap weights, which right now is about 60% US, 40% non-US, so that changes over time. But you can, turn that dial to be 100% US, 100% non-US, anywhere in the middle. And clients regularly do turn the dial, sometimes to reflect their own views, but more often to reflect where they need diversification in their portfolio. So if we have clients who outside of Elm are heavily, heavily invested in the US, they might turn the dial more towards the non-US, or vice versa, um, to help Elm better fit into their overall portfolio. Um, so the first two dials are about the baseline, and the third dial is a dynamic scaling dial. And Victor discussed how the core of what we do is adjusting the portfolio as excess expected returns change and as market risk levels change. And the dynamic scaling dial controls how dynamically we do that. So if you set it all the way to the left at 0, you'll just have a static portfolio at the baseline weights. And that's fine. We have some clients who do that. We'll still do trades to keep the account at the baseline weights. We'll do tax loss harvesting. We'll manage it normally, but there won't be too much to do. As you turn the dial further to the right, the scale of dynamic adjustments as market conditions change gets bigger and bigger. The theoretical optimal setting is 100%. 100% is the setting most consistent with portfolio theory. But one nice thing about the framework is that even at 50%, you get most of the benefits of fully scaling, but with a portfolio that's not as dynamic, that's more comfortable for some people, it's not moving as much, and for taxable accounts that can be more tax efficient. These are dials that you set as part of the onboarding process with us, but that then can be changed anytime afterwards. Jerry, let's move on. So one tool that our investors use both to think about what dial settings they want, and once they're invested with us, to keep track of what we're doing, is our allocation viewer. And you can, anyone can see this on our website anytime. Just go to Tools, Allocation Viewer. All right, Jerry, next slide, please. Oh, actually, sorry, go back 1 second. Sorry. And I should note that there's a few options here that we haven't shown. One is you can click this button to switch to the history, which will show you for any given set of dial settings, the history of asset allocations over a period of time. And then this table is looking at the detailed breakdown of the asset allocation at one point in time. And we're going to look at, in the detail that's followed, we're going to look at the setting 75, default equity mix, and 100% scaling. All right, next slide. So the first, going from left to right, the first column here is the baseline weights. So this is driven by the dial settings you select. And this is if we were, strangely, in an environment where all global equity markets had a 4% risk premium and neutral risk level, what would your portfolio be? And so in this case, it would be 44% in US equities, 30% in non-US equities, and 25% in fixed income, with the detailed breakdown below that. Now, the current target weights column shows, given the actual state of the environment and your dial settings, where are we rebalancing your portfolio to now? And so that's 29% US equities, 41% non-US equities, and about 30% fixed income. And you can use this table to understand why the portfolio is where it is. Looking at the just the broad US column, but the logic we're going through is the same for all of these, basically. Next slide, please. So the deviations between the baseline weights and the target weights come from, for US equities, from risk premia being different from 4% and from risk level not being neutral. So we're going to first focus on the risk premium differential. So the current risk premium for broad US equities is 1.2%. And that's because the cyclically adjusted earnings yield of US equities is about 3% right now, 3.2%. TIPS real yields are about 2%. So you take the difference of those, and broad US equities are earning about 1.2% over TIPS real yields, which we take to be the safe asset. That 1.2% is a lot lower than 4%, which is our baseline calibration point. In particular, it's about 25%, the baseline level. Now, if you look at the risk premium, so you'll see that the deviation of our baseline weights from risk premium is a significant fraction of the baseline itself. Now, if we were following the logic of our portfolio theory, it should be about 25% of the baseline weight. But you'll notice that the deviation is only about 2/3 of the baseline weight. And that's because we cap the impact of risk premium to plus minus 2/3 of the baseline weight. So if we didn't do that, this risk premium deviation would be even bigger. Okay, next, please. So while risk premia are decreasing our allocation to broad US equities, on the other hand, market momentum is very positive right now. Risk level is low. And when risk level is low, momentum is positive, we're increasing our allocation by 1/3 of the baseline weight. And so risk level is low, we're increasing it by 11.6. That's about 1/3 of the baseline weight. The two together add up to the total deviation between the target weight and the baseline weight. So you can see that the target is about 11% underweight relative to the baseline, and that comes from just adding up the risk premium deviation and the risk level deviation. And this same logic holds for all of the equity buckets. And then for the fixed income buckets, we don't have a valuation metric. We only use the momentum risk level metric. And I've gone over this kind of at a very high conceptual level right now. But we have a white paper where all of the detailed calculations and in the theory behind this is explained in much greater detail. And there's a link to it here in the deck, which you'll receive after the call.
Great, thank you, James. So probably noticing a bit of a theme. Obviously, we're very highly focused on efficiency and everything we do, and that really applies to kind of the nuts and bolts of how we manage accounts. So we separately manage accounts at Fidelity, Schwab, and JP Morgan Private Bank, which is just a really fantastic structure in a lot of ways, but not limited to the fact that all of the portfolio holdings stay in your name. And basically have daily liquidity as soon as an ETF trade can settle, which is one day. And actually, I've already gotten a question about this, but we can start with cash or existing held assets. To our knowledge, we are the only sort of systematic investment manager that can start with a held asset, and this is something that we're working with clients on pretty regularly. People will contribute, highly appreciated single name equities that they are looking to avoid having to sort of pay some significant tax bill around, and so we'll kind of manage around that. It can offer some sort of diversification around a specific equity, a specific position. If this is something that applies to you, probably worth having a sort of separate conversation, but that is potentially an option. On the tax front, obviously, we're highly focused on taxes and really think that anybody who's managing investments should be thinking about post-tax everything. And so we offer tax loss harvesting as a sort of standard in all of our taxable accounts, and also have some options for potentially increasing some of the harvesting opportunities through some different tactics that we can use. Again, if that's something that is interesting to you, probably worth setting up a separate conversation. And then on the cost front, so we charge 12 basis points from a management fee perspective, and then we're highly focused on always finding the lowest cost ETF to sort of meet our high standards, and so constantly looking to reduce the 6%. The 6 basis point expense ratio of our ETF holdings. Over to you, Mike.
Hi, I'll try to keep it short and sweet. I like to think like the onboarding process itself. So you'll go to our website and there's a video running, and you'll essentially follow some steps to either request that we open a new account in your name or the name of an entity, or add Elm to an existing account at Fidelity or Schwab. Once you go through this onboarding process, you'll receive the investment management agreement and sign that, and then we'll get an email saying that you went through it, and myself or Brandon will reach out. Brandon's another colleague of ours, with either the application to open the new account or the paperwork to add Elm to an existing account. And I'd say for most standard accounts, we can get the process done in under a week, maybe a couple days. And then once the account is open, I guess Jerry already went over this. Yes, you can fund the account with assets or cash, and we can assist with that if it's an asset transfer from another brokerage account, or if it's from another Fidelity account or another Schwab account. Typically, you'll have to enter that request online. If it's a wire or another sort of transfer from a bank, that will also need to be initiated by you, but we can go over those specifics in the event you open the accounts. And I guess once the account is open and the assets are transferred, we can give you an idea of what the tax impact might be of rebalancing, or if you'd like to average cash in over X number of weeks, and then we'll confirm the dials with you, and we're good to go.
Great. So yeah, last thing before we get into the Q&A, a little bit about Elm. So we currently manage around 2 billion of assets for 400 clients and families. Almost exclusively work with private individuals and families. We've been around since 2011. We're as Victor mentioned, a small but mighty team of 6 based here in beautiful Philadelphia. So we do, in addition to obviously our investment management services, all of our clients are, we host twice a year, we host a big Zoom call, which is sort of a, investor forum, talk a lot about kind of what we're seeing. What we're seeing in the markets, how the portfolio is working. And it's a really fun kind of big Q&A with the whole group. In addition to the regular, obviously, account statements, we also write at length on a quarterly basis about what's going on in the portfolio and other things that are sort of top of mind for us. And then one of the things we started to do a lot more recently is in-person events. We just had a big event at the Harvard Club in New York with about 150 friends and clients. We had a panel with Professor John Campbell from Harvard, who's sort of a really interesting thinker about personal finance, and it was sort of a really fun event. And obviously, I've been doing a lot of events around the launch of Victor and James's book, The Missing Billionaires. Hopefully some of you have heard of it or read it. If you haven't, definitely let us know. We'll make sure we get a copy of that book over to you. As you can see, I have a number of beautiful ones right over my shoulder here. So so that's a little bit about Elm. Getting a lot of great questions in the chat here. I will kick it off with one of a kind of a theme that I'm seeing. I'll actually start with you, James. Do you think you could say a little bit about, well, 2 things. Say a little bit about the tax efficiency of a portfolio that's managed in the way that we manage. So that, and speak a little bit about perhaps the difference between a taxable account and a non-taxable account, retirement account, et cetera.
Yeah, sure. So first, let me say we manage plenty of non-taxable accounts. We can manage IRAs, we can manage certain types of non-group 401ks, um, and we can manage nonprofit accounts. And taxes aren't an issue for those. Um, and so we can that makes the rebalancing on our side a lot easier. From a portfolio construction standpoint, um, programmatically, the only thing we do differently is we don't hold munis in those accounts. But we're not big believers in people significantly altering their asset allocation between taxable and non-taxable accounts on the grounds that um, the calculation for how to do that heavily depends on assumptions about tax rates and tax structure far in the future, um, which we don't think there's enough visibility on to warrant really significant asset allocation deviations between taxable and non-taxable accounts. So turning to taxable accounts. Um, in taxable accounts, we do a number of things to enhance the tax efficiency of what we do, whether we're doing it dynamically or not. Um, First, let me say everything I'm going to be talking about, in terms of the tax efficiency of a static account or the tax efficiency of a dynamic elm account, is way off on one side of the spectrum of tax efficiency at the very efficient spectrum. And, depending on exactly what your tax situation is and exactly what happens in the markets, it could be a little bit less or a little bit more tax efficient. But regardless, we're talking about highly tax efficient investing strategies in general. Um, so the first thing we do is whenever we rebalance, we do so in a tax sensitive manner. So whenever we go to rebalance your portfolio, we have an execution optimizer, which says, okay, I want to find a parsimonious set of trades which mutually optimizes for maximizing realized losses, minimizing realized gains, minimizing transaction costs, and minimizing tracking error relative to our portfolio targets. And at any given time, that could result in no trades. It could result in some trades that realize losses. It could result in some trades that realize gains. But the optimizer is going to work pretty hard to avoid realizing short-term gains and pretty hard also to avoid realizing long-term gains unless there's a sufficiently large deviation from our portfolio targets to justify it. We are also going to do regular tax loss harvesting when available at the ETF level. So if you own a US total market index ETF and it's at a loss, we'll sell that and replace it with another US highly diversified ETF that tracks a different benchmark so that it's not a wash sale. So, for example, we might sell VTI, which tracks the CRISP US Total Market Index, and buy IVV, which is an iShares ETF that tracks the S&P 500. One technique we have to increase the amount of expected tax loss harvesting is at your option is instead of holding the US market through one ETF like VTI, we can split it up into each of the individual sector funds, hold those. There's more dispersion across the sector funds than the total market. So the total amount of expected tax loss harvesting is greater. The tax efficiency of the dynamic strategy is also a function of the dynamic dial you choose. So at a 50% dynamic setting, which is where most of our clients start, That's a setting that gets you the majority of the benefits of 100% dynamic scaling, but which is significantly more tax efficient. So comparing, making normal assumptions about tax status, tax situation, tax rates. At 50% dynamic, we think that, the implied long-term tax rate of the portfolio is within, 1% or so of a static portfolio. So not quite as tax efficient, but very, very close. And like I said, both are well on the far end of the very efficient spectrum in the range of investments from very tax efficient to very tax inefficient. Let me stop there.
Great. Thank you, James. Kind of synthesizing a few questions here. Victor, could you speak a little bit about whether, how you feel about if the comment of, is this timing the market? So is dynamic asset allocation an attempt at timing the market in some way? And this is very relevant given that Victor was at a Bogleheads conference in Minneapolis a few weeks ago, and timing the market is the enemy of Bogleheads. So.
Yes. Yeah, actually, I think, one thing we should do, and maybe we'll put it into that group chat, is to have a link to an article that we wrote a couple of weeks ago that was talking about dynamic versus static asset allocation. But, I think that this question of, is what you're doing market timing, and isn't market timing bad, and so what you're doing is bad? We get that question a lot, not necessarily quite in that form, but I think that's what is meant. And so, I think what's important is to first try to understand what do we mean by market timing? What do people mean? What do we all think about market timing? Because there's something that's called market timing, and I think there's a perception that it's bad, that it's not a good thing, and that research has said market timing is not a good thing. So, what is the definition of market timing? And then let's compare it to what we're doing. Well, I guess these days what we like to do whenever we're trying to define something and we're not too sure about it is we go to one of the LLMs. So just a few minutes ago, because I was seeing this question come up in the in our online questions, I knew that this was going to be a question we were going to talk about. So I typed into ChatGPT 4.0 what is market timing and how does it compare with dynamic asset allocation? And so I think that ChatGPT did a really, that their answer really aligns with how we think about it. So let me just read you a little bit of that. So sorry, one second. Where was that? Okay. So it says, market timing and deciding on a dynamic asset allocation based on expected return and risk are fundamentally different in their objectives, methods, and execution, although they both involve responding to market conditions. Here's how they differ. So it has a bunch of points. I'm going to summarize some of them. So market timing seeks to predict short-term price movements in the stock market, aiming to buy low and sell high to maximize returns over brief periods. Dynamic asset allocation focuses on long-term investment goals by balancing risk and return across various asset classes. Adjustments are based on expected returns, risks, and broader market and broader portfolio considerations, including investor risk aversion, not based on short-term predictions. Time horizon. Market timing operates on a short-term horizon, often days, weeks, or months. The goal is to capitalize on immediate market trends or events. Dynamic asset allocation has a longer-term focus, often spanning years or decades, which is very much how we think about it. Methodology. Market timing relies on market predictions, often using technical analysis, economic indicators, or news events to anticipate near-term market behavior. Dynamic asset allocation uses a systematic approach grounded in expected returns, risks, and an investor's risk tolerance and investment horizon. It is informed by principles of diversification and risk management. I'll skip some more there. Market timing carries high risk due to the difficulty of accurately predicting short-term market movements. Mistiming can result in significant losses or missed gains. Dynamic asset allocation aims to manage risk by diversifying investments across asset classes and aligning the portfolio with the investor's risk tolerance and long-term objectives. And then I'm almost through it. I think it's worthwhile, though. We got this question 3 or 4 times in the group chat. So an example of market timing is an investor selling all stocks today, expecting a market crash next month, and with plans to buy back when prices drop. That would be kind of, a good example of market timing. Maybe before the election, thinking whoever was going to win the US election was going to be bad or good. And so, either depending on your view, playing the election like that. That's not something that we would do. And again, ChatGPT, dynamic asset allocation would involve, an example would be an investor gradually reduces stock exposure as expected returns decline relative to bonds, keeping the portfolio balanced according to their long-term risk and return targets. And then just finally, the key takeaway, market timing is about reacting to short-term fluctuations, often speculative, while dynamic asset allocation is a disciplined strategic process designed to optimize long-term investment outcomes, what we would call risk-adjusted returns based on expected risks and returns. So it almost seems like I wrote that for ChatGPT, but I didn't. Maybe ChatGPT was like, oh, dynamic index investing, and they went to our website and pulled all of that off of it. I'm not sure. But anyway, I think that's a really good description. And, what I would say, what ChatGPT didn't say, but what we would say is, what's the alternative to building your portfolio based on the expected return being offered by the things you're going to invest in, risky and safe assets, and the riskiness of these risky assets? How else could you build your portfolio? Like, if you're going to follow a static asset allocation, what's the logic behind that? And I think that, it's such an important question. I just want to run through like a thought experiment to imagine, what this difference is. So imagine that you're given an opportunity to play a game where you're going to be able to bet on a biased coin, and I tell you, here's a biased coin, and you can bet your wealth on it. It's biased towards heads. Okay, I'm going to tell you that it's biased towards heads, but I'm not going to tell you how biased towards heads it is. So you don't know if it's 51-49% on heads, or if it's 75% going to come up heads. You don't know. And you say, okay, thank you. I love to bet on a biased coin. That's good. And you decide, well, you don't know what the bias is, but you say, okay, well, I'm just gonna bet 5% of my wealth on heads on every flip of the coin. So that's one thing that you could do, and that's one approach, and that would be what I would call a static asset allocation. That somehow, that the stock market in general has a positive expected return relative to bonds, but you don't know what it is. You don't know how risky it is. So you decide, I'm just going to bet a certain amount of my wealth on stocks forever without ever asking the question of what it is. Then in the other case, I tell you, here's this biased coin, and I tell you this coin has a 60% bias towards heads. And you say, oh, great, thank you for telling me that. And now you say, okay, I'm going to bet 10% on the coin, and then I say to you, oh, I'm changing things now. Now the coin has a 55% chance of landing on heads. Now, should that person say, well, I don't care about that. I decided before that I'm going to bet 10% on heads every time. So thank you for telling me that, but I'm not going to change my asset allocation. I'm not going to change my betting, even though you told me the coin is less attractive now. That would be totally illogical, irrational, right? You would say, no, well, I'm going to bet less of my wealth on this 55-45 coin than I wanted to bet on the 60-40 coin. And that's exactly what we're doing with dynamic asset allocation. What we're doing is not based on some kind of market inefficiency. It's not the way that stock picking is a zero-sum activity, where if you're picking some stocks, that you can only win if somebody else that doesn't own those stocks loses. It's a zero-sum activity. But asset allocation and deciding how much you want in stocks based on expected return and risk is a totally rational approach that's consistent with markets being efficient, but expected returns changing and being observable. And so, that's how we think about it. But we understand why people think about dynamic index investing and they're like, oh, this is market timing. Market timing is not good. But I hope that between ChatGPT and my own description, and maybe also the paper that we wrote, that we have convinced you that this is a sensible way to invest. We realize, as I said in my opening remarks, there's not a lot of places you can go to get somebody to do this for you for a low cost. You can get managers to do dynamic asset allocation for you at a high cost subjectively, where they're kind of doing market timing. They're reading the tea leaves. They're thinking about all different things. You don't know exactly how they're coming up with their changing asset allocation, but they do change your asset allocation in a rather subjective way that is more like market timing and also carries a much higher fee because they're employing a bunch of experts that are trying to analyze the tea leaves. So we have a lot more questions. I'll stop there, but I think that was a really important one.
Great, thank you, Victor. So this question for you, James, and I'll change slides. Could you talk a little bit more about two things? One, how we think about risk and volatility, specifically how we assess that as at a risk level in our asset allocation, and then a little bit about how often we rebalance the portfolio, the sort of theory behind the decision that we've made there, and both of those things.
Yeah. So the theory behind the asset allocation rule we want to use is, and we go into this in much greater detail in our book and in the white paper, is that we want the asset allocation to be proportional to risk premium and inversely proportional to variance, or the volatility squared. Now, instead of having a metric for forward variance, we use a momentum signal. And we do that because volatility scaling and momentum are deeply connected for equities. And if you use a momentum signal versus you use kind of a complicated volatility scaling regime, you're going to get very similar results. But using the momentum signal is much more straightforward, direct, intuitive. And so that's what we use as a proxy for risk level, where when momentum is positive for equities, we say risk level is low. And when momentum is negative, we say risk level is high. It's not literally binary. There's a small transition zone, but most of the time it's pretty binary. And the metric we use for momentum is we basically take a total return series, we put it into constant dollars, we adjust it for risk premia, and then we look at the current level of that series divided by its 1-year average. And if the current level is above the 1-year average, then we say, momentum is positive, and it's below, then we say momentum is negative. So that's what's driving the risk level. We rebalance the portfolio weekly to the 4-week average of our target weights. And the reason we have this averaging in there is, especially for the momentum signal, we don't want the target weight volatility of just rebalancing to spot momentum at high frequency. That would make the portfolio weights we think just inappropriately unstable and dynamic for an individual portfolio. But on the other hand, we don't want to just rebalance one day a month, which introduces quite a lot of time idiosyncrasy into the portfolio management. So instead, we rebalance weekly to an average of the signals. And that's an innovation which which we've been really happy with how it works. And again, every time we rebalance, because we have this execution optimizer layer, it doesn't necessarily mean we're doing trades. Whenever we do a reval of all of the accounts, the execution optimizer contemplates doing trades, and it may do something or it may do nothing.
Excellent. Thanks, James. I'm going to throw it back to you in a second, but we've gotten a few questions on returns back test, which we have. For compliance reasons, we can only share it through reverse inquiry. So if people are interested in seeing a returns back test, you'll get an email after this call. Respond to that email asking for it, and we'll send it your way. For like I said, for compliance reasons, we can't post it online. However, we think that the returns back test in coordination with the asset allocation tool that James walked through, we really like that as a way to sort of determine if intuitively this approach makes sense. I like to recommend that people look at it through market cycles that are familiar to them, like COVID or 2008 or some of these other cases where they sort of remember how valuations and risk were, they sort of remember those things either in a good way or a bad way. And I think looking at how the portfolio, the composition of the portfolio and how it responded in those cases, I think is a really good way to sort of determine if this is comfortable or appropriate for you.
Well, can I just say these questions? I just went through all of our, so we've answered a bunch of questions, and these are just great questions. I wish we could just go for hours and answer these. I guess what we'll have to do, that we're going to stop at some point, and I think what we'll wind up doing is taking all these questions and hopefully we can capture them and then answering them all in the email that we send back to everybody. So, everybody who's asked a question that we don't get to will be able to, you'll get your answer in a follow-up email, but really terrific questions.
Yeah. Okay. Let me see if I can do this one. Synthesize a few things here, James. This one, I'll go to you, James. We've gotten a few questions about how people think about the dials and from a few different angles. So one, how people should think about making the dials for themselves or what that process is like. It's obviously a very critical decision. So how people should determine those types of things. I know you covered that briefly, but maybe talk about how we see the dials as a way to sort of build an Elm portfolio in relation to all the other things that people may be investing in. We got a question about obviously why we don't have why the instruments that we have are the ones we have, no alternatives, things like that. So maybe speak a little bit about how Elm fits into someone's broader portfolio and how people sort of use their broader portfolio to think about what their dial setting should be.
Yeah, so we really view our mission at Elm at helping clients harvest the returns available from major global markets really efficiently. And the dynamic index investing comes into that through being efficient about risk, not taking too much risk when you're not being appropriately compensated for it in expected return terms. But that idea of wanting to harvest global market returns efficiently influences almost everything we do. It's why we do everything algorithmically. It's why we use only highly diversified, super liquid, super low cost index ETFs. If your goal is harvest global market returns efficiently, you don't really need more than that. Jerry, what was the other question?
How to think about so sort of a couple questions
how to think about the dial settings, right?
Yeah.
So,
from a few different angles, perhaps in relation to the rest of someone's portfolio, and then if someone's investing in things, private investments, real estate, et cetera, how we sort of talk to people about that when they bring those types of things to us.
Yeah. So first, let me say for clients who or potential clients who really want to dig into this with us, we have a process focused on lifetime portfolio choice and consumption, very much along the lines of what we describe in chapter 7, 8, and 9 of the book, where we spend time with you trying to understand your financial situation, your risk aversion, your spending profile, your balance sheet, and use our modeling tools to answer some high-level questions about your optimal both spending policy and asset allocation. And we charge a little for it. We charge $5,000 for going through that. And some clients want to do that with us, and we kind of take a deep dive with them. Plenty of other clients just tell us what dial settings they want, and and that's fine too. And the way I talk to people about it, is basically that based on your risk aversion, based upon your how much spending volatility you can tolerate, how much portfolio volatility you can tolerate. One of the most important questions you can ask for yourself is how much risk should I be taking? And I use, how much equity risk as a proxy for, how much overall risk. And, for some people, that might be 100%. For some people, that might be 50%. And, let's say for you, it's 80%. And, if that's 80%, then you want the sum of all of your equity assets across all the things you're doing to be about 80% of your net worth. And, so how you set Elm your Elm dials is going to depend on what that headline number is and what else is going on. So, for example, if if you have nothing outside of Elm, then you should just set the Elm dials to what you want for your overall portfolio. Otherwise, you should set your Elm dials to get your overall portfolio in line with the right risk level for you.
Great. Thanks, James. I think we have time for about one more. And I guess, Victor, I'll throw this one to you. So I think a really good question here, and probably something we could do an entire webinar on, but could you talk a little bit about sort of how you see, the value add of Elm, and what are the benefits for considering an approach like this in someone's portfolio or for their family savings?
Yeah, great question. So, first of all, let me try to answer the question for me personally, because I'm not sure that there's even that much beyond how I feel that Elm has been and is great for me, and I know that for many people they feel this way. So, for me, this is the way that I want to invest. So I'm so happy that Elm exists to put into practice this way of investing. I can't think of any other way of investing other than looking at expected returns of the things that I want to invest in, the risk of those things, and combining it with my own risk tolerance to come up with an appropriate portfolio at each point in time. Now, Elm is solely focused on low-cost public market liquid investing, and that's where I want to be too, because I feel that as a U.S. taxable investor, that's the most efficient way for me to invest. I know that hedge funds and private equity and venture, often generate terrific returns, but on an after-tax basis and imagining the fees that are embedded in those strategies, I'm just not that. I don't want to have that as part of my family's savings. And that brings me to the second way in which I think that the Elm approach is really great for me and my family, which is that if I did think that investing in private equity and hedge funds and so on were really good, I feel like I would be sending the signal to my family, to my kids, my wife, the people around me, that that you need to be very active and spend a lot of your time managing your wealth. And that's not how I want my kids to think about investing. I want them to do what they want to do with their lives and to get financial freedom means that they don't have to spend a large fraction of their time, monitoring and managing their wealth and, looking for the next, great trade and great manager and all of that. And I don't even think, I don't think that I can do it. And I've been, immersed in finance for my whole life. I think that my kids, God bless them, they're all smarter than I am. But I don't think that if I can't do it, I don't think that they have a high chance. I don't think all three of them jointly, each one of them, I don't think each one of them has a high chance, of doing it. And it's just because it's the most competitive sport on the planet. Beating the market is more competitive than, being a professional golfer, probably. If you think about all the people that try to play golf and the ones who get, into the pro tour, I think that the people who can consistently beat the market are probably a smaller fraction of all the people who are trying to beat the market. So Elm just gives me this peace of mind. And again, as I said earlier on, that by doing a dynamic asset allocation, I can over time, I feel that I'll have more equity exposure than I would be comfortable with if I just had to set it and forget it for the rest of my life and tie myself to the mast like Odysseus did to not change my portfolio. I just think that a static asset allocation is a total straw man in terms of what you're going to do. Like you're going to, that I think that people are either going to, be changing their asset allocation periodically, by the seat of their pants in a subjective way, or they can do this kind of an approach. I just don't think that the static asset allocation is even a really credible multi-decade approach to investing. So anyway, those are some of the things that I like about Elm. I probably missed a few other ones out, but yeah, that covers most of it.
Perfect. And right at 12 Eastern. So I think that's probably a good place to wrap it up. Everyone here, you'll hear from us shortly, and we'll capture these questions and sort of try to see if we can kind of come up with some themes and maybe a way to answer them for the broader group as well.
Yeah.
So great.
Yeah. Thanks to 3/4 of you staying on, from beginning to end also, and all these great questions. Terrific.
Yeah.
Thank you.
Thank you very much.